Hi, my name is Kunal, and welcome to the Geeks of the Valley podcast, which connects with some of the brightest minds globally who are leading their respective industries today to discuss the hottest upcoming industry trends and how their work is affecting the global economy. This morning, from the San Francisco Bay Area, we have a successful serial entrepreneur with executive experience at Google and Facebook and current founder and managing partner of Electric Capital joining us. Please welcome Avichal Garg. Avichal, thank you so much for joining us today.
My pleasure. Thank you for having me.
And how are things with you in light of COVID?
Actually, things are pretty great. Crypto is pretty global, and so it hasn't impacted our day to day that much. And I used to be a little bit of a remote work skeptic, and I still am in a lot of cases for high growth venture backed startups. But actually, for a VC firm, I mean, there's only five of us at the entire firm. We're quite small. And VC firms tend to scale with capital rather than people, right? So your team stays pretty small. So I actually think for a VC firm, it might work. So it's still a bit of an open exercise here. We just hired our first team member truly remotely, and it's gone really well. And so I've actually been kind of pleasantly surprised at how well it's worked for us. Running a VC firm is really different than running a crypto protocol is really different than running a high growth venture backed startup with 1,000 employees. So yeah, I'm sure it's different for different types of people.
Avichal, so you mentioned something about remote working. What are your thoughts on this in the VC industry, and how do you see playing out long term for VCs?
Yeah, I think, well, I think first remote means different things to different people. Um, and I think there are actually sort of two or three different definitions rolled in there. So some people use remote to mean distributed, which is that everybody's working from home and working whenever they want, and you can be anywhere in the world. And I think that actually won't be the case for most companies. It creates a lot of logistical overhead, and actually for a lot of people, like things like childcare are challenging, and so working from home, and maybe you don't have enough space to work from home if you and your spouse both want to do it. There are a lot of logistical challenges there, and I think for other people, work actually fulfills a really important social function. Right? It's actually where if you move to a new city and get a new job, that's how you make friends. That might be how you find a significant other. So it's actually, a friend of a friend, through somebody you know at work. So there's actually a really important social function. So I'm a little skeptical that most companies will go fully remote. I do think that there's a variant of it, which is uh, sort of remote friendly, which is I think people can work from home whenever they feel like it, but people still converge on a central office for a lot of things. And so, there's still no replacement for sitting next to somebody and having lunch or drawing on a whiteboard together or looking at designs and pointing at stuff. And I think it's unlikely that we replace 10,000 years of human evolution with, I just don't think the tooling is there yet for us in like the next 12 months. Um, and so I suspect what will end up happening actually is a lot of companies will move towards like a hub and spoke model where there will be offices, and you can go use those offices whenever you feel like it, and you and your team can converge in a place. And most of the rest of the week, everybody sort of can work independently and get work done and save commute time. So I don't think the office is going away. I don't think we're going to a fully distributed workforce anytime soon. Maybe in 10 or 20 years. But I do think we're going to see an interesting transition to sort of this more hybrid model where you can work from home a couple days a week and come into the central office, 1 or 2 days a week.
Very interesting. Let's jump into the first question here, shall we?
Mhm.
Tell me about yourself and your background and how it led you to the path of founding a blockchain and crypto focused VC fund. They seem to be a little more common nowadays.
Yeah, yeah, there are more and more of them. I think when we started, there were only a handful in 2017. So my path was, I started at Google. I was working on search ranking and ads ranking. Um, did two startups. Sold my second one to Facebook, where I was then a director of product. And that second startup that we sold to Facebook, kind of on the back end, we built some really robust mobile infrastructure, some crawling infrastructure. And at the time, this was 2010, 2011, my co-founder and I were also doing some Bitcoin mining at home. He comes from a distributed systems background, and he'd worked on some distributed systems and thought Bitcoin was really interesting because it might solve the sort of incentivization problem. Like, why are people going to participate in your network? He'd worked on things like protein folding at home, if you remember that. And he thought Bitcoin was really interesting from that perspective of maybe it would incentivize people to run computation on this distributed system. And so we started mining a little bit kind of pre-ASIC era. And since we had all this infrastructure that we built for our startup, we decided maybe actually it makes sense to do some Bitcoin mining at scale. And so in 2010, 2011, we thought about becoming Bitcoin miners. And we decided, you know what, actually probably doesn't make sense. That market is, maybe Bitcoin's never going to be a thing. And so we decided to ultimately sell the company to Facebook. We were essentially hobbyists in crypto for a while. And after we left Facebook in 2016, that's where we were spending most of our time. And so in 2017, a bunch of VCs, kind of with the last Bitcoin price run up that was happening, a lot of VCs were coming to us and saying, "Hey, I remember you guys telling me about Bitcoin years ago. Is it real this time? Should we buy some? What's Ethereum? What's an ICO?" And so we were spending a lot of our time in 2017 essentially doing education for people that were interested. Some of them were VCs, some of them were, like university endowments, and people were just sort of asking for advice to try to get their heads around it. And kind of by the end of 2017, most of the VCs in Silicon Valley and around the world had realized that they're not really structurally set up to invest in crypto. Little things like how do you do custody of these tokens to the regulations and the compliance that you have to deal with is just different when you're dealing with liquid assets. And so a few of them approached us at the end of 2017 and said, "Hey, you guys really understand this crypto stuff. You're spending a lot of your personal time there, and that's where you're investing your personal money. Could we just give you guys money? Can you just do what you're doing, but do it with our money as well? And we know that you're not going to go buy some anonymous cryptocurrency and like run off to Costa Rica or something. So can we give you some of our money to invest?" And so that's how Electric happened. Is basically a bunch of VCs came to us and became investors in our fund, became LPs in our fund, because they just wanted us to basically keep doing what we were doing, and they weren't really set up for it. And so in 2018, we formalized a lot of our investment activity into Electric Capital, and since then have gone on to be early investors in a number of layer one protocols. Obviously, we own Bitcoin and Ethereum, but also things like Near, Coda, Oasis, Mobilecoin, and investments in companies like Bitwise or Anchorage. And so, kind of 2018, we were focused mostly on layer ones, and we just raised our second fund earlier this year in 2020, which is kind of our first institutional fund. So that's mostly from university endowments and nonprofits and philanthropies, and I've continued to invest kind of in layer ones, DeFi companies in and around crypto.
Now, that endowment aspect seems to be very interesting, right? It's usually endowments are very risk adverse, right? They don't tend to make these alternative investments. So have you seen a change now that universities are like, hey, we want to now start investing in really future emerging technology?
Yeah, so I think kind of two things happened. So one is in 2017, with the last price run up, a lot of people started to pay attention, and the price got a lot of people intrigued. It was hard to ignore, and it was in the press. And as people went down the rabbit hole and did their research, they realized that there is actually real utility behind the scenes. And once you start digging in, you realize that things like Bitcoin and Ethereum are novel technologies and unlock interesting new utility in the world. And so that sort of started a lot of institutions down this path of thinking about investing in the space. But of course, you have to get consensus inside an institution on whether or not to make a new sort of investment. And so I think that evolution and that process took 2 to 3 years, and there was a lot of education from a number of people. And I think one of the big catalysts was Andreessen Horowitz raised a dedicated crypto fund. And I think when they did that in 2019, it really sort of opened the gates, I think, for institutions, because what it did was a number of institutions had to decide whether or not to invest in that fund. And Andreessen Horowitz is an extremely successful venture firm. And generally speaking, when you're an LP into a venture fund and they've made you a lot of money, it's a good rule of thumb to keep giving them money, right? They're clearly very good at what they do. And so along comes somebody that you really trust. Let's say you're you're a university endowment. Along comes somebody, an investment group that you work with that you really trust, that's made you a lot of money over the years, has been really early to emerging technologies, has invested in some of the best companies of the internet of the last 20 years. And they say, hey, we think that this new emerging technology sector is really interesting, and we're going to create a dedicated fund just to invest in that. And by the way, we have an exceptional group of partners that are dedicated just to this fund. It's something you have to take really seriously. And very reasonably, a lot of, I think, institutions at that point said, you know what, like every time we've listened to Andreessen, we've made a lot of money. It's been a great investment strategy. So we should probably trust them. We should just give them money. But what that did as a second order side effect, and that fund I think will do phenomenally well if you kind of look at the timing of it, and kind of the investments that Andreessen made. But if you sort of think about the second order effects, now what happens is, let's say you're a university endowment, or you're a healthcare system, or a large philanthropy, or a large nonprofit that wasn't previously invested in crypto, and you're not in the Andreessen fund. Now some of your peers are, and so now what you have to do is you have to justify your position at zero. Previously, when there's nobody investing in crypto, everybody's at zero. So there's sort of an implicit zero, and you don't have to justify that position. But as soon as some of your peers start moving off of zero allocation in crypto, and dedicated crypto funds, and off zero in Bitcoin, all of a sudden you now have to justify why you're at zero, because some other really, really smart people are no longer at zero. And I think that dynamic really changed, roughly like early mid 2019. And I think Andreessen was a big catalyst here. And once that happened, I think the combination of the research that people had been doing for 2 or 3 years, us having participated in a number of such educational sort of opportunities for some of these institutions, and tried to help them understand these things, and having offered them data and tried to be good, just educators and shepherds of information. Plus sort of the realization that the market dynamics had changed such that now as an institution, you have to justify zero. A lot of people are at the point where they said, you know what, actually crypto makes sense, and allocation there to dedicated funds makes sense. And I think we were sort of on the short list of a handful of folks. It's us, Andreessen, obviously, Paradigm, a small number of folks that sort of are institutional caliber funds with partners and background that sort of is a fit for those sorts of LPs, and an investment strategy that makes sense, and so on and so on. And so we were able to partner with some really great institutions. And so I think we were on the early end of it. I think Andreessen and Paradigm were ahead of us in terms of opening those doors and helping facilitate move the market along. And then I think we're sort of shortly behind them. And I think what we're starting to see now going into 2020 and 2021 is the rise of big corporations like Square, MicroStrategies, take these kinds of positions, but also large investment firms take these positions. And I think increasingly it's becoming a thing that institutions, and capital allocators have to consider. And I wouldn't be surprised if basically, we look back and 2020 in retrospect is going to be the year that investing in crypto went from being crazy to being consensus. I think this is kind of the year where it kind of shifted, and we went from it being just this crazy thing, like why would you do that? Why would you have Bitcoin, or why would you have crypto in your portfolio? To this year, sort of all of the smart money is moving to the other side and saying, you know what, you probably should have some allocation to crypto.
So going off this point, what is the fund's current size, investment philosophy, and ticket size?
Yeah. So our first fund was 35 million. Our second fund is 110 million. So about 3 times bigger. Our ticket size for the second one, it ranges. We can invest in tokens, and we can invest in equity. And the dynamics around token rounds and equity rounds are often very different. And we can dig into that if you're curious. But what that means net is that our ticket sizes are anywhere from 250K to 10 million. And because some of the things that we're dealing with are tokens that can have more liquidity than traditional equity, even though it's 110, we might actually end up deploying more than that. You can imagine that, like what's happened this year is that Bitcoin and Ethereum have really appreciated in price. And so maybe it actually makes sense for us to recycle some of that into other projects going into next year. And so we may actually end up, it's funny, we may only raise 110, but we may end up deploying into projects a lot more than 110, depending on kind of how the market works out. In terms of the way that breaks out across tokens and equity, in tokens versus equity, one of the biggest and fundamental differences that you have to think about as an investor is that generally with equity, you're trying to increase your ownership, and outcomes are often very directly proportional to ownership. So you really want 10, 15, 20, 25% if you're an early stage investor. And so that's kind of how people think about it, is I need to own 20% of a company for the math to work as a VC. In token networks, actually, if one person, if one entity, if one investor owns 20% of a network, it's a huge liability to that network because kind of by design, these are supposed to be distributed and decentralized systems. And one entity owning that much of a network is actually a liability to the resiliency of the network. And you kind of don't want that degree of concentration. And so generally speaking, even if we're the earliest investors in a token project, we generally will not take more than 10% of the token network. And often we're taking less. And so at the early stages, often that may mean we only invest 250 or 500K into a token network because our constraint actually is we don't want to own too much of it. But it's a very different mentality from pure equity investors, where actually as an early stage equity investor, you want to own as much as you can. In a token network, you have to be really mindful of not owning too much.
So when looking at this token-based dynamic, right, how does it affect, the traditional cap tables or term sheets?
Yeah, so it has a couple of interesting side effects of that. So one is, the way that you think about how much of the token network to take is just different because you actually may not want to own too much of it actually. The second sort of side effect is because you can't own too much of it, you also have to be mindful about how the round is constructed. And so we find that at the early stages, the angels and the VCs end up being a lot more collaborative because they have to be. Um, it's not like one VC can take 20% of it and elbow everybody else out. You often have to have two or three people collaborating, and you know, three people take 7% each, or three people take 5% each, or something like that. And so the dynamics in terms of investors collaborating with each other, we found that crypto ends up being much, much more collaborative, even amongst the VCs, which is kind of a fascinating phenomenon. And then what you also see is that actually the token networks increasingly are being constructed such that actually neither the investors nor the founding team owns the majority of it. You're actually seeing 50, 60, 70% of the token supply going to the users and going to the community, which really is, one of the driving ethos here is the motivation behind the scenes is that you want to create these networks where the people who are the users of the networks participate in the economic upside of the network being successful. And so actually, when you say that, normally when we think about equity, it's sort of ideally what you end up with, if you get to an IPO, is that founders still own a lot of it, and then investors own a lot of it, and that's kind of it, right? And often employees own a very small amount, and relative to, let's say, the investors, and users own almost nothing, right? And actually, token networks are almost the exact inverse. Often what you'll see is users own a lot of it. Employees and founders are often much closer together in their equity, and investors often own a minority, which is great. I think that's actually, it's an interesting different search space and sort of the funding landscape of how things get funded and what kinds of ideas that's a good fit for.
And this perfectly transitions into when it comes to blockchain and cryptocurrency. Why is it that traditional VC funds cannot do it so easily?
Yeah, so I think this is one of them. I mean, I think the idea that you can only own 5 or 7% of a token network makes it really challenging. Part of it is that the social networks around these companies are different. Like the founders all know each other, and those are different networks of people. Part of it is that when these networks launch, they're semi-liquid, and so thinking about liquid assets is it's a different muscle. And so you have to think about how to invest in those things differently and track those things differently and manage your portfolio differently. Part of it is just the custody of it. So, like you invest in a token network, and you have to have a wallet, and you have to run a node, maybe, and you might have to stake your assets so that you don't get inflated away. And so Electric spends a lot of time, we write software, we work with third-party custodians as much as we can, but often we have to write a lot of software in-house to manage the portfolio. And that's just not a thing that most VCs do or want to do. And I think there's a little bit of sort of innovator's dilemma. Like being a VC, if you're an established VC firm, is a great business, right? You can raise hundreds of millions of dollars. There are lots of really interesting SaaS and marketplace and fintech and sort of traditional companies as software eats the world. So there's plenty of opportunities for you to deploy capital. And so why pursue this new thing, right? It's a lot of work. It's relatively smaller a market than some of these other markets that you can invest hundreds of millions of dollars into. So it kind of doesn't make sense, from a business perspective, to pivot your firm to this new market, unless you really think that the market growth of crypto is going to outstrip everything else, and it's going to be 100x bigger than it is, which we certainly do. But even so, like you could have a fantastic business doing what you continue to do as a VC today without ever touching crypto. And so, it's a combination of like it's a lot of work. The work is really different, and you already have a pretty great setup if you're a successful VC firm. So the impetus to change, there's no existential threat there right now. And so as a result, you just don't see the existing VC firms here. You're seeing this whole new crop, setting aside Andreessen, which I think is a fascinating case study and sort of being thoughtful about potentially disrupting your own business. But um, by and large, what you see are VC firms that are not the traditional guys. You don't see, Sequoia and Benchmark at the table. You don't see Excel, right? You don't see sort of the names of Kleiner. You don't see the names that you're used to other than Andreessen. And so you're seeing this whole new crop of emerging VCs come into this ecosystem.
Now transferring over to the DeFi space at a higher level, recently you've kind of seen public companies such as Square buying 50 million worth of Bitcoin and PayPal allowing crypto or Bitcoin spending on its platform. What are your thoughts on all this? Is it also about the current general uncertainty around the global financial system?
Yeah, there's a lot to unpack there. So I think it's a bit of a perfect storm. So for a long time, what people have really said about Bitcoin is that it has a lot of really interesting properties. Namely, it's digitally scarce and provably scarce. It's fixed supply. It has some really interesting utilities, like it's easy to transport. It's seizure resistant. It's hard to take away. It's pseudonymous. Like nobody needs to know that you have Bitcoin or how much you have or what your wallet addresses are. And when you start enumerating those utilities, you say, wow, this actually looks a lot like gold. This actually looks like maybe a digital gold. That's actually better than gold in a lot of ways because it's easier to transport. It's easier to transact with. It's easier to sell. It's, global. There's 24/7 market for it. There's always actually really interesting new properties for it. And the downside, of course, is that it's highly volatile, right? It can lose 70 or 80% of its value as it has in the past. But the utilities are potentially something that's interesting for people that seek that kind of utility. And for a long time, like who really cared about a non-sovereign asset that was fixed supply and that was hard to seize? And I think what happened in 2020 between COVID and the resulting quantitative easing that happened is a lot of people woke up to the idea that actually maybe all these Bitcoin people that for the last decade, post global financial crisis of 2008, have been talking about this idea of unlimited money printing and fiat currencies being devalued and governments inflating assets, um, and potentially that leading to societal imbalances and wealth disparities, which can cause all sorts of downstream issues. Maybe those people were right, and it took sort of the systemic shock of COVID plus the economy grinding to a halt plus basically unlimited quantitative easing that came on the other side of that for people to say, wait a second, maybe quantitative easing is not going away, and maybe all these things around fiat, money printing, all this stuff is actually true. And if you start to say, well, maybe it's true, then you start looking for a thing that has certain properties, namely that it's fixed supply, the government can't print it away, it's hard for the government to take it away from you. It has all these properties, and so all of a sudden, Bitcoin starts to look really interesting. And so I think what you had was basically COVID unlocking and accelerating, in this case, the Bitcoin narrative and people waking up to it. And because of the last 2 to 3 years, like we talked about, a lot of institutions were kind of primed for it. And so I think you just had this perfect storm of for the last 2 to 3 years, institutions being ready and open to the idea, plus the systemic shock that sort of reinforced the narrative, the fundamental narrative. And so a lot of new money started to come in and say, okay, maybe this isn't so crazy. Maybe I should have 50 basis points or 1% of the portfolio from an institutional lens. Maybe that should have exposure here. And so I think that's what you're seeing now. And so you're seeing sort of this slow buying effect that's, I think, been happening for much of this year. In addition, what you've had, that's sort of the demand side. The other side of it that we look at is the supply side. And one of the things we track is what is the circulating supply of Bitcoin looking like? Like who holds it and where is it? And what we've seen for the last 2 years is that if you look on chain at the Bitcoin wallet addresses and you look at people who've owned their Bitcoin in that wallet address for more than a year, that percentage of Bitcoin is now about 60%. It's actually 65% almost. So almost 2/3 of the Bitcoin in circulation hasn't moved in a year. It's basically been sitting in a wallet address. And at the height of the bubble, in the last bubble in 2017, December 2017, January 2018, that number got down to about 38%, 35 to 38% had been held for more than a year. So 2/3 of the Bitcoin almost in existence at the time had been transacted in under a year. And so what you saw was really like this reshuffling, right? A bunch of people sold their Bitcoin in the run up in 2017. And then after the market peaked, essentially from 2017, January 2018 to today, that Bitcoin has slowly, that supply has slowly been shifting into the hands of people that don't want to sell it. And so it's been moving into the hands of people that don't want to sell it. So you kind of have this supply and demand thing happening where supply is slowly moving into the hands of people that don't want to sell it. And demand is coming in because people are recognizing potentially the underlying utility of this thing. And that combination, I think, is creating some of the market price effects that we're now seeing. And that I would expect to continue.
So this next question really talks about how the current political environment is playing a role in this vertical, and that role being a CBDC, or a central banking digital currency. You recently wrote an article outlining why the US government needs to work with the crypto community to stand a chance against the Chinese government. You spoke about modernizing USD settlement platforms as an alternative to the digital RMB, making crypto dollars broadly available in mid 2021, and creating regulatory clarity to unlock decentralized cryptocurrencies as an offensive tool, and therefore expanding the reach of the USD. First of all, what is a CBDC? What is important about the role it plays in today's economy? And can you touch a bit more in detail about some of these points you mentioned in your article?
Yeah. So, well, to define it to that specific question that you have, a central bank digital currency is basically just a currency that's issued by a government on a digital settlement platform. So, today we print cash, and it's kind of a weird anachronistic thing. And the thinking is that, well, you could just have digital cash. You could just have a thing that the central bank, the Fed, basically issues. They send it out to the commercial banks. It gets out, through them to retail banking, and it sort of starts to circulate into the economy, just the way cash would today, or effectively cash does today. And you can make it digital. And if you had a digital platform, it'd give you a lot of nice properties. Like you could instantly see how much money is out there. You could see where it's flowing. You could dynamically change interest rates. There's a lot of cool stuff you could do. And so it just feels like modernizing a bunch of existing old infrastructure away from paper, and away from data systems built in the 1970s to things that are built in the 2020s. And so that's just sort of a modernization effort. And the Chinese government actually is sitting at the forefront of this. They've been investing in central bank digital currency infrastructure, digital currency payment infrastructure for the last 5 years. And so they're already doing some tests in various provinces in China around being able to issue digital currency out to the banks and ultimately the fintechs. And that then allows people to have mobile wallets, and you can pay for things without having to have cash. And it has a bunch of really interesting, nice properties. And so that it feels almost inevitable at this point. Like that's the way the world is going to go. There are going to be digital currencies. There are going to be central bank digital currencies issued by the central bank, and they're effectively one for one with the dollar or the Chinese yuan. So, with China in particular, it's interesting because the question is, well, what are they going to do with that? It's effectively a new technology that they have, this digital currency, and what could they do with it? And what you're seeing them do with it is they're taking that and they're moving it along their Belt and Road Initiative, which is kind of this hundreds of billions of dollars of infrastructure spending that they're doing all along Asia, Africa, Gulf, into Europe. And it's part of their sort of national security program to create these alliances and to have strategic ports in the world, and to have economic tie-ins with certain countries for China, the Chinese economy, but also for national security purposes. And what they're going to do is they're going to take this digital currency and push it through the Belt and Road Initiative and offer it as a settlement platform for trade, which is fantastic, right? If you're currently, in some port in Sri Lanka or East Africa or in the Gulf, and you want to buy oil, or you want to buy goods, or there are goods coming from China, or you're sending raw materials to China to get processed, all of that today actually happens, it's denominated most often in US dollars, and the transaction often has to settle in very old infrastructure. And so if you could go to all of these businesses in these countries all over this Belt and Road and say, why don't we just settle instantly? You'll get your money immediately in your bank account. It's auditable. It's totally digital. You can get on your phone. Like, businesses can get their money faster so they can pay their employees more quickly. They have more turnover in terms of being able to use that capital, and so they don't have to go get loans from banks. There's like a bunch of really nice second order effects of having this kind of a platform. Um, so of course, all these businesses and all these countries are going to sign up for that. But that creates a really interesting challenge for the US, because actually the US dollar as a tool of national security is a very important tool, right? It allows the US to understand what's happening all over the world. It sort of ties people into the US economy in a very deep and important way. It gives the U.S. leverage to do things like sanctions. Like sanctions don't work if people are not using the dollar, right? Because if they can circumvent the U.S. Dollar system and the banking system, then sanctions are useless. And so, setting aside the morality, or like which side are you on, or do you have any feelings about the Chinese government or the U.S. government? Just set all that aside for a second. Just sort of play out the game theory of it. If the Chinese government is following a certain path, the question then opens up, well, what should the US government do given all of this? Given the role that the US dollar plays in national security for the US, and given what China is doing with digital currencies and their CBDC. And in our opinion, the answer is that the US actually needs to do three things. The first is they need to invest in a central bank digital currency platform of their own. And they need to do that quickly. Now the problem is it's going to take several years for that to actually be developed and tested, and it's a lot of work. And the U.S. is starting from several years behind. So the U.S. should kick that off, and that's an initiative that should get going and be invested in. But if that's the only thing that you did, you now have a problem, because for the next 5 to 10 years while you're building that platform out, that's a 5 to 10 year head start for the Chinese government on Belt and Road. So again, purely game theoretically, that's likely not enough. So the question is, what else can you do? In our opinion, prong two of the strategy should be that you should take all of these crypto dollars that are floating around in the crypto ecosystem right now and essentially greenlight them, and embrace them. And so if you look in crypto right now, USD stablecoins are clearly one of the killer apps of crypto. There's about $25 billion worth of USD stablecoins sitting on top of Ethereum right now. And some of that's going to go back into buying more cryptocurrencies. Part of that is being used for lending purposes to generate yield. Part of it is that people want to keep their money in USD, and actually being able to move money around the world 24/7 is really nice. But if you look at where most of that money is sitting, it's actually sitting offshore, which is not great from a US government perspective. And so our proposal is essentially what the US government should do is, in addition to investing in their own central bank digital currency, is they should embrace the idea of a crypto dollar and bring all of those dollars back into the US banking system. So they're actually sitting in a bank in the US rather than sitting in some bank outside the US. And so at least they're sitting in the US jurisdiction. And actually, if you greenlight them and you say, hey, you know what, we're okay, we accept the idea that they're going to be USD stablecoins built on top of Ethereum and built on top of Near and built on top of Polkadot or whatever, then what you could do is you could actually accelerate the adoption of these crypto dollars all over the world, because Ethereum and Near and so on are going to be available everywhere. And now you would have in market a USD competitor that could actually potentially compete against the Chinese digital currency platform, because people actually want the dollar. They want the dollar more than they want the yuan. And so if you just have a credible alternative in the market, maybe the world just says, you know what, I'll just use the US dollar version, and it's sitting on this open infrastructure. And maybe you can get a bunch of platforms like Libra or Celo, which have dollar systems, and really embrace them and accelerate them and give them regulatory clarity. And if you did that, you might actually accelerate adoption of the dollar all over the emerging markets, and actually essentially be defense against the Chinese digital currency system, and essentially let that play out in the market, but accelerate, because right now the lack of regulatory and government clarity makes it really hard for those USD stablecoins to really take root in a meaningful way. So that's kind of prong two. But all of that still sniffs very defensive to us. Like, that's great, you should do all of those things, but the Chinese government is very adept at using technology, and they're gonna push this. And so, if you kind of go back to startup 101, how do you win as a startup? Well, you win as a startup by doing the thing that your competitors cannot do, that the incumbent cannot do structurally, right? So for example, Snapchat won against Facebook in many ways because Facebook was all about permanence, and they were all about identity, and everything you'd ever done and every photo you'd ever taken was inside Facebook. And Snapchat was the exact opposite of that, right? Snapchat was about no permanent identity, and ephemerality. So the content disappeared. And so structurally, there was no way for Facebook to compete with that easily. And so the question here is, if the US government really wants to compete against the Chinese government, what can they do that structurally the Chinese government cannot compete with? And in our opinion, the answer actually is embracing the open cryptocurrency ecosystem, because on the open ecosystem side of it, you have all these really interesting properties to these cryptocurrencies, things like privacy, non-sovereign, decentralization, open ecosystems of developers that are building tooling and building applications, censorship resistance, effectively free speech. And these are all values that align with the American government's values and are very antithetical to the Chinese government's values. And so is it likely that the Chinese government greenlights private currencies? Probably not, right? It creates some really structural challenges for them to have truly private currencies. And so what you can do is by using the cryptocurrencies that are in market already that sort of have these properties that the Chinese government structurally is unable to embrace, you could actually offer alternatives in market that the Chinese government can't compete with. And that's kind of prong three, in our opinion, is actually embrace the things that are well aligned with the US government's philosophical opinions, but are antithetical to what the Chinese government is able to structurally accept. And if you do that, you can offer effectively a differentiated product to market. And in doing so, you would actually allow the ecosystem of currencies, the ecosystem built around the open currencies to flourish in the US. And so all of the value that gets created on top of these things would exist then in American companies. And that then ultimately gives you leverage over this ecosystem. And this is a playbook that we've seen play out before. This is, for example, how the internet worked. And so that, in our opinion, is sort of the three-pronged strategy that the US government should use, given that the Chinese government is taking a certain course of action. And again, this is not, we tried to be as unbiased as possible in sort of writing this paper. Our goal was not to say, we're crypto investors, so, obviously we're going to be biased, but our lens on it was very much, what is the game theory here and what is the optimal strategy for the US government? And kind of where we netted out was they should do a CBDC. They should actually embrace crypto dollars. And actually, probably they should embrace cryptocurrencies, because cryptocurrencies will offer benefits that the Chinese DCEP cannot. And in doing so, you can actually have the ecosystem built on top of cryptocurrencies exist primarily inside the US, and that's then how you get leverage.
Avichal, I think you bring up a really good point when it comes to this One Belt, One Road initiative, also known as Ilu. I think what many governments really don't understand yet is that whoever wins this CBDC race will give certain countries economic strength over others. You look at countries like you mentioned, such as China, Singapore, Hong Kong, who are really openly testing this through their sandboxes and within the local banking system. I mean, what are your thoughts on this? This could, right, be somewhat of a national security concern to some extent.
Yeah, it's absolutely a national security concern. I mean, I think currencies are a tool of national security, and I think if you lose the grip over currency, if you lose the ability to use that strategically, then you've lost a very important tool of national security. And so I think that's exactly right. And I think it's also important, I think, to call out. I don't think the Chinese government is necessarily trying to become a reserve currency to replace the dollar. That comes actually with a whole host of challenges. But I do think there's an advantage to them, to the Chinese government, or to the Russian government, or to the Iranians, to having a system that does not have that does not rely 100% on the U.S. dollar. And so having an alternative system sort of depressurizes what their current situations and allows them to exist outside the U.S. dollar reach. And so you could actually end up in a world where most of the world's trade is still done in U.S. dollars. The U.S. dollar is still the primary reserve currency, but there's enough of an alternative system that's settled in yuan that those countries are now free to do what they want. And so effectively, you've neutered the value of the U.S. dollar and actually potentially put the U.S. in the worst possible situation, because now you also have all the baggage that comes with being the primary reserve currency of the world. Namely, that you have to sort of your population has to subsidize that by purchasing cheap goods from all over the world and take on debt. That's sort of how you make your capital account balance work out as a country if you're the world reserve country, because you have this sort of new source of demand for US dollars outside of your own country. And that could actually be potentially even worse, right? Because you've sort of got all of the baggage of being the reserve currency, but you don't have the advantages of being such the dominant world currency that you get sort of influence and national security leverage over other people. And so I think that's actually, in my opinion, the most likely outcome if the Chinese government is able to keep executing on their plan, is that they're able to circumvent the US dollar, but not have to take on the baggage of being a primary reserve currency.
And to wrap up our call with our last question for today, what piece of advice would you give to people out there from the journey you've had so far in life, both to entrepreneurs and current venture capitalists who are maybe potentially wanting to go into this specific space?
Yeah, so I think if you look at all of the best investors and entrepreneurs, one of the common threads is that picking the right market really matters. And it's funny because that's true if you talk to Sequoia, and it's also true if you and they're venture investors and they focus on technology, and it's also true if you talk to Warren Buffett, right, who's a value investor who says he doesn't invest in technology, but he has a very similar mentality. He has a phrase that's something to the extent of when a market with a terrible reputation meet the management team with an excellent reputation, only one of the two retains its reputation, and it's not the management team, right? In effect, like the market is the dominant thing here. And so, for anybody that's thinking about crypto, I think what's fascinating about it is that the market structure feels to me a lot like the early internet. And if you could go back to 1992 and you had prescience and you could see everything that was going to happen for the next 20 or 30 years, what would you have done? What would you have done differently if you could go to 1992? And my guess is what you would have done is you would have tried to find Amazon. You would have tried to work at Yahoo. You would have tried to understand how the internet was working. And even if you weren't able to be in Silicon Valley, even if you weren't able to be in Seattle to work at Amazon or Microsoft, you would have eventually found your way there if you just worked in that market, right? You worked at your local IT, company, and eventually you get there. And so I think, from the lens of crypto, I think this market is just starting. And I think we have about 20 to 30 years ahead of us of really transformation. I think this is going to eat up global financial markets in a way that is going to surprise people over the next 20 to 30 years. And that journey is going to take so long that we're in the very, very early stages of it. And so now is a fantastic time to be getting in. The groundwork is just being laid. A lot of the primitives of how this whole ecosystem and this whole market are going to work are just being put down. And the quality of people is exceptional, and the community is still quite small. So I think it's a fantastic time to come in. And the best way to do it is to just do it. Everything is public, everything is open source. You can go to Twitter, you can go to Telegram. It's just sort of unparalleled access and transparency. And so just jump in. If you look at most of the people in the space, they don't have more than a couple of years of full-time experience anyway. So it's not like machine learning or something where you're starting at a 10-year disadvantage. By and large, you're only talking about people that have 2, 3, 4 years of experience. And there are not a lot of markets that are growing at the rate that crypto is, where you can jump in and be a world expert in 2 or 3 years. It's pretty rare that you sort of see that alignment. So I think everybody that's interested should just come join.
Quite a big bet that you're making there, Avichal, and it's great to see that prediction, and hopefully it does end up playing out that way. I think there's a lot of opportunity in this market, personally, kind of from what I've seen.
Yeah, me too.
Avichal, it was a pleasure having you on Geeks of the Valley, and thank you so much for joining us today.
My pleasure. Thank you for having me.